9,000. That's JPMorgan's new S&P 500 target, and it implies 30% upside from where we're sitting right now. This just dropped, and most investors don't realize what it means yet. Here's what's really going on, and what you need to be thinking about right now. Because if this call is even half right, the cost of sitting on the sidelines just got very, very expensive. JPMorgan analysts have officially laid out a bull case. S&P 500 at 9,000. Not in 5 years. By the middle of next year. That's roughly 30% upside from current levels. In under 12 months. Let that sink in. The index is already on an 8-week winning streak. One of the longest runs in recent memory. Momentum is not slowing down. It's accelerating. The Dow just set a brand new all-time high. Right now, markets are sending a signal. And it's loud. JPMorgan's thesis rests on 3 pillars. Resilient economic growth, AI-driven earnings expansion, and easing geopolitical tensions. The AI trade isn't cooling off. It's being baked directly into forward earnings models at the highest levels of Wall Street. Macro tailwinds are lining up. Rate pressure is easing. Corporate earnings are holding up better than the bears predicted. And institutional money is rotating fast. But here's what nobody is saying about this yet. There is an estimated $6 trillion sitting in money market funds right now. $6 trillion. Earning yields that look great today, but could look like a massive opportunity cost by mid-next year if JPMorgan's target even comes close to materializing. The real risk for millions of investors isn't volatility. It's being left behind. First consideration. Audit your equity exposure today. If you're underweight equities relative to your long-term allocation, the gap between where you are and where you could be is widening in real time. Second consideration. Look at your tech and AI exposure specifically. JPMorgan's bull case is anchored in AI-driven earnings growth. Broad index funds with heavy tech weighting are direct plays on that thesis. Third consideration. Stress test your bond and cash allocation. In a 30% rally scenario, over-allocation to fixed income isn't safety. It's a drag. Talk to your advisor about rebalancing thresholds before the next leg up potentially prices you out. 30% upside. An 8-week winning streak. $6 trillion on the sidelines. The setup is unlike anything we've seen in years. What do you think this means for your portfolio? Drop it below. This conversation is worth having right now. This video is for educational purposes only, not financial advice. Always consult a qualified financial advisor before making any investment decisions.